What's up traders? Tom here with another video. Today we'll be discussing the money printing machine, the Federal Reserve and Jerome Powell. Can they print forever, or is there a limit to their power? We'll also be taking a look at our technical analysis thoughts after the Nasdaq has made pretty much an equal high with its previous peaks, and the S&P 500 and where it's currently sitting. Have we reached a point of real resistance? Stay tuned. So whether you're a bull or a bear, I think everyone can agree we are in uncharted, crazy territory when it comes to central bank monetary policies. Today, we will look at how far realistically these policies can be pushed before it potentially all explodes, and what this might mean for you as an investor over the longer term. I'd also like to remind everybody that if you've been enjoying our videos, make sure to subscribe, hit the bell, give this video a like, and of course, comment down below with your thoughts on the current state of the financial markets, whether you're a bull or a bear at this current time. I'd also like to remind everybody that we have a Discord trading and investing community down below in the links that you can join and get involved in the greater trading community and share your thoughts and ideas. So get involved today. We'll start today's video with the Fed analysis last year, which warned of economic ruin when governments print money to pay off debt. It almost seems laughable when you consider where we're at right now, only a few months later. Remember, this article was written on November 25th, 2019, and boy, have things changed. They certainly have. So where can central banks go in terms of policies? Well, it's clear that central banks are set to print a huge amount. In fact, it's predicted that they're going to print around 5 times more money than the previous peak. So that's some pretty amazing numbers. But what about a limit? Is there a limit? Well, when you look at certain statements that have been made in the past, and I think this guy should know what's going on, being Alan Greenspan, he was a former Federal Reserve chairman, and he said the United States can pay any debt it has because we can always print money to do that. And this was in 2011. And then he said, so there is a 0 probability of any defaults. And that's an interesting and powerful statement. Now that was back off the previous quantitative easing, but it shows the idea of what he was thinking and what a lot of people do believe. So Fed Treasury purchases have come down. We mentioned this in a previous video. They've come down from their peak where the Fed was stabilizing the market, and now they've entered a bit of a consolidation in terms of just a steady amount of purchases and slowly lowering each week. So I think the Federal Reserve is pretty happy with where they've currently pushed at least the stock market, and they're trying to cool things off from that perspective. They're not worried about the increased volatility that was there before. But what about the central bank policies? What can we learn from other central banks? Well, one of the things that I always like to look at is Bank of Japan and also the ECB, because in many ways where they pushed central policy during the GFC will teach us what is possible and potentially even what could happen even further into the future. So here is a chart of the total assets of major central banks. Every single one of them has obviously increased recently, with the Fed increasing the most with their current stimulation into the economies. We can see what the ECB had to do around 2014. I've mentioned on this channel, once you get into these type of deep policies, you can never get out. And the monetary system has changed forever because of what these countries have done and what the central banks have done. But more about what has Bank of Japan done and what is that teaching us about what is humanly possible when it comes to these policies? Well, I like this one here, the total assets of major central banks as compared to their GDP. So here we have the Bank of Japan, and a few people are probably aware by now, the Bank of Japan is over 100% of their nominal GDP. When compared to countries like the PBOC or the ECB, they're more around 40% in terms of their total asset holdings. And then you have the Fed down here at just around and above 20%. So in perspective of what the Bank of Japan have managed to achieve without exploding yet, the Federal Reserve actually have a lot more in the tank than some would believe. If this chart was the only reason and the only thing you were looking at what is possible. So what does the Bank of Japan really own? Well, we've mentioned this in a video before, which I'll tag above. And basically it looks like they have around 40+% of their total bond market, and they hold all of them. Now, this creates many market issues like liquidity and certain things like that in terms of functioning markets. But when you compare it to what the ECB and what the Fed has, it's massive compared to where they're currently at. So it looks like in this case, the Fed has more room than we think. At the beginning of this crisis, many people were talking about all of the different ways that the Federal Reserve can potentially stimulate the economies. One of those was interest rates at zero, forward guidance, treasury twists, which you can read about on thebalance.com, quantitative easing, which we all know about, and there are some others as well. But what I found interesting is when researching this topic for everybody, I actually found these articles from our man Ben Bernanke, who was also a former Federal Reserve chairman, and he talks about 3 policies. Now, I think negative interest rates, pretty much Jerome Powell has said he does not want to do this, and the committee does not want to do this. But it is one option on the table, and not many people believe that this option works, so they're going to use that as the last resort. If they're using negative interest rates, we have many things to be concerned about. So let's hope it never comes to that, because that could be their last policy before they run out, because they do not want to do it under any circumstances. Another one that Bernanke had, and you can look up these articles, was targeting longer term interest rates. It's definitely something they're probably going to do. And the last one, and the one that he's almost well known for, is the idea of helicopter money. Will they ever do this policy? Most likely not. But it is one that has been floated in the past. So where will the Federal Reserve balance sheet be in the next couple of years? Well, this article is taken from Forbes.com, and it looks like projected size of the balance sheet is expected to be between 8 and almost $10 trillion, with some people theorizing upwards of $11 trillion to get the US out of the current position that they're in. Does that mean that all the jobs are going to come back? Most likely not. That is just to stabilize the economy to a point where it doesn't continuously crash. So here are the jobs. We have jobs numbers tonight. Obviously, they are continuing to decline, but just because they're declining, you still have a huge amount of jobs lost. As you can see up here, 40.7 million, with another expectation of at least around 1.8 plus million lost jobs just in the last week. So it's pretty scary numbers there. Quite a lot of people have been talking about the idea that you cannot print jobs. I tend to agree with that. You cannot bring back unemployment easily. Remember, the numbers were from the GFC to now, we have lost the same amount of jobs that were lost in only the first couple of weeks. So all the jobs that were put on over that time have now been lost plus more. And it does take economies a long time to get back from it. So what about more checks? Did anyone say more free money? Well, of course, it's not free because someone has to pay for it. And unfortunately, it will most likely be the American taxpayer. But there is a proposal to now increase the amount of money coming to people. And I'm sure many people really need this, and that is important. But at the same time, it looks like another couple of $1 trillion are coming through the pipeline, and expect that to be beneficial to the stock market as well, because people will have that instant sugar rush where they can spend that on potentially buying more shares, potentially buying and paying for things, and maybe even buying something discretionary. So all of this money goes back instantly into the economy somewhere, and people will generally spend it relatively quickly, most likely on things they really do need. So let's talk about the S&P 500 and the NASDAQ. Well, one thing's for sure, put-call ratios are down. On this channel, we've been talking about when people don't expect something to happen, it often happens. And put-call ratios are a really good way of looking at that. So put-call ratios have entered 1.08, and this must be the lowest point they've been pretty much since the crisis, I believe. If we look here back to March 24th, Put call ratios were about 1.11 around March 25th, around those lows, around March 25th. And since that point, they've been relatively high with a lot of people, a lot of retail traders as well, shorting the market. Now we're seeing the lowest put call spread. So let's see if that keeps up, or indeed the market, which has hit some resistances, begins a small correction. So here we have the NASDAQ, and it looks like we are about to realistically hit the all-time high. The big V shape has happened, and we are hitting the resistance of just before 9,800. So around 9,700 resistance, 9,750 resistance. Would we expect some kind of pullback from this zone? Technically, you always would. You would say, if I was taking profit and I was a very large trader that was actually trading and saying, okay, I don't want to invest in this money, I'd like to take profit and I think there'll be a pullback, where would be the most optimum point for us to take profit? Well, psychologically, it would be at the previous peak or just before, because that's a clear point of resistance that is undisputable. Everybody's going to be looking at this zone and saying, hey, that could be a point where I might take my profit and take my really quick gains and say, okay, well, that was one of the best trades I've ever done in the last couple of weeks / months. And I would get out and expect some kind of pullback. So often this is the self-fulfilling prophecy that happens in the markets. Tonight we have unemployment. Tonight we also have what the ECB is doing when it unveils its current stimulus policies. But if you expect a pullback, this would be the point. And we've mentioned on the channel that back into 9,000 could be kind of a reload zone before the market potentially goes back up. Will the market crash? Well, it looks like the Federal Reserve has a decent amount of stimulus that they can still put into the markets. And as we saw with that Bank of Japan, there is more to go and they can do it if they want to. Will they want to? Time will tell. But that is something that you should always keep in the back of your mind since the market is ever evolving. So the US 100 NASDAQ is definitely at an all-time peak resistance, and it makes sense for it to have some form of weakness at this point. So what about the S&P 500? Well, the S&P 500 has now reached resistance at the previous highs in March before the second crash and the second move down. And this is a point where you would expect the markets to do some hovering and probably people to start taking some profit. Remember, it comes at the same point where we saw the put call spreads at a really low rate. And whenever you see put call spreads at a really low rate, it basically just says that more people are starting to buy calls and believe in the market. What does that mean for Wall Street? Well, Wall Street love stealing money off everybody. So if that's happening and people are losing faith in the bear side of things, then now they could potentially push the market slightly lower and get the buys that they probably want, because many Wall Street people will have missed this bull rally. And if they believe they want to hold stocks long term, they might want to push the market down before they take it further longer in the future due to the Federal Reserve's change in policies over the last couple of months. So if you've enjoyed this video today, make sure to subscribe and hit the bell. Of course, give us a big thumbs up. It really helps us on YouTube as a growing community. And I just want to shout out, and I really appreciate everybody for subscribing to this channel. It keeps me motivated to making these videos every day. They're not that easy to always create one for. So, YouTube's not as easy as I thought it would be, but at the same time, I love sharing these ideas and I really do appreciate each and every one of you. So big shout out to the trading community, and we'll see you in the next video. Happy trading, everybody. Bye.